Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Desk Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch. Hello, everyone. Normally during these Weekly Watch podcasts, I have a bit of a preamble, but I also like to keep them short. So this week, in the interest of the latter, I'm actually going to turn right to our special guest, which is Ross Walker, our Chief UK Economist. So Ross, last week we had Brian Dangerfield, and he was talking about energy prices, how he saw it impacting things in Europe and the UK going forward, and how it was contributing to this whole stagflation narrative. Well, just like that, the markets have gone from stagflation to pricing in potential rate hikes, and in some cases, which is why you're here, policy mistake. So in the UK, at least that's how I see it, as a policy mistake pricing. Again, to some degree, you can argue how much. But you've got a series of rate hikes priced in now to the 1% area, rate hikes priced for next month, and then lower rates after rates peak, they have rates coming back down. This has also been reflected in the fact that the UK curve has seen a huge amount of flattening, with the long end rallying while the front end is selling off to price in that policy hike, but then lower long rates as we think that's going to come off relatively quickly. So I'm going to be blunt here. What happened, and why has Governor Bailey and his crew gotten so hawkish so quickly, and not just accepted that the markets have started to think about rate hikes and price a little bit in, but actually seemingly encouraged that line of thinking and a lot of pricing?
Yeah, it is quite striking, certainly when you compare the BoEs signaling with that of the Fed or the ECB or pretty much every other central bank on the planet, one or two exceptions. Fundamentally, we've seen sizable overshoots in inflation versus the BoE's forecast. Now, again, there's nothing unique about that. I think that's common to most jurisdictions. But the BoE also seems worried about some evidence of a faster erosion of spare capacity, notably in the labor market. They reference some early evidence of rising wage pressures relating to bottlenecks, skill shortages in parts of the economy. Now, admittedly, some of this, there is a structural dimension around post-Brexit economic arrangements, but I think that risks conflating some of these medium-term structural issues with some of the shorter-term forces. But fundamentally, the BoE just is worrying more and more that inflation expectations are going to lose their anchor. Now, providing hard evidence of this is not easy. I don't really see a lot of evidence for that. And they may have talked themselves into an unnecessarily hawkish or hasty tightening position.
So do you think that they raise rates next month? And if so or not, how do you see the rate path playing out?
Well, it certainly feels like a question of when rather than if, and November versus even December or February next year, it feels like a coin toss. They've clearly given themselves the option to raise rates in November. There are at least 3 of the 9 members, I would say, who have signaled that they are not ready to vote for rate rises. So the November call is in the balance. It's certainly not a done deal that they hike, but I think given the signaling, it would be extremely surprising if they do not raise rates by February.
Okay. And if they do end up, okay, let me say, where do you think, rates end up in this cycle? And then not necessarily what market's pricing, right? But where do you think they actually end up raising rates to over the course of, let's just say, the next 12 months?
Well, this is where the major uncertainty lies. And I think why, as you mentioned in the introduction, you're now seeing some curve inversion and essentially a sort of policy mistake beginning to be priced. Because what they really have not articulated is what is the medium term, the underlying strategy here? Is it simply that they're a bit worried about near-term inflation? They want to reinforce the inflation anchor. So they deliver 2 or 3 modest interest rate rises over the next year. It's a sort of gesture to signal, to shore up their credibility. More ominously, I think, for the real economy, they are taking the view that, well, we have an overall 2% inflation target, and if we have a more persistent global supply, energy-centric price shock that results in higher goods and energy inflation, then we will just have to bear down much more heavily on the domestic economy to arithmetically offset that higher external inflation. And I think that's, as I say, a deeply concerning outlook for the domestic economy, which is recovering. But I think you'd be hard pressed to provide compelling evidence that the UK is in the midst of some sort of consumer boom or rampant credit explosion. It looks like a more prosaic recovery, very much in line with what we're seeing in other parts of Europe and in the US.
So you voiced really kind of what one of my concerns is as I watch this play out, from the outside, which is you have an external supply shock, an energy shock, but it's not exactly a demand-led recovery. So you're pushed down on demand, but that doesn't necessarily influence what really is the cause of the issues. So I think you could tell in my tone, I'm a little surprised to the extent to which this has gone, but nevertheless, here we are. So one last question. Have these higher rate expectations, and as you said, the coin toss, when they go, but it seems pretty clear they're going to. Given what your comments, has that influenced your growth or inflation outlooks? And have you lowered any of your growth forecasts for like next year into next year?
Yeah, we've begun to lower our growth forecasts through 2022. Firstly, to take account of the energy shock itself. The UK is also something of an outlier in the fiscal policy sphere. We have some tax rises, sizable tax rises coming next April, with subsequent income taxes a further year down the line. So although the overall UK fiscal stance is not a contractionary one, the incremental policy measures are pushing in a tightening direction. So you have some fiscal headwinds as well, which will constrain consumer income. And then, of course, we have the rate rises. Now, there's a degree of insulation for the UK household sector. About 80% of the outstanding mortgage stock is linked to fixed rates, but those fixes are typically only for 1, 2, 3 years. So there's quite a high frequency resetting. And I think those three headwinds, tax rises, the energy price shock, and higher mortgage debt servicing costs, are clearly going to squeeze disposable income and real consumption.
Okay. All right. Well, thanks, Ross. I think that's probably enough for today. I don't know if I could take any more. It is incredible times for the UK. So I think for the rest of us, for the coming week, UK markets are probably going to continue to heavily influence the rest of the world, especially as it's a relatively quiet week outside of some consumer surveys on the data front. We do have the ECB meeting, and Ross, as you mentioned, Bank of England is very much, I think, unique in the way that they're reacting to these recent developments. On the ECB side, we see a very different reaction function where, if anything, we expect the ECB to push back against any pricing of ECB hikes. Not that they've changed any communication, but just this spillover effect from the UK to other global markets. If anything, we think that they might just reiterate their dovishness, which will, again, kind of make that differentiating approach or different approach even more stark. So thanks for joining us, Ross. That's it for all this week. And thank you, everybody, for listening.
I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.